My guest today is Markus Brunnermeier. Markus is a professor of economics at Princeton University and an advisor to institutions including the Bundesbank and the US Congressional Budget Office. With a PhD from the London School of Economics, his research focuses on the intersection between financial markets and macroeconomics, with a special emphasis on inflation, financial stability, asset bubbles, and liquidity crisis. He is the author of several books, including a definitive account of the Euro crisis, the Euro, and the Battle of Ideas. Hello, Markus. It's great to have you here. We've been working together for many years. You were the originator of this whole doom loop idea during the Euro crisis already, I think, 10 years ago, thinking about the link between the sovereigns and the banks and back from the banks to the sovereigns, how the crisis in one leads to a crisis in the other side of this loop. And I wanted to talk about whether this is going to be, in your opinion, repeated in this crisis. What are the risks? We also, before going there, we also made a proposal at the time, which we called SBs, the European Safe Bonds, and it was taken as SBBS by the European Parliament. It passed in the European Parliament. This is the unlikely proposal by some academics that actually makes it all the way almost to the end, because in the European Council it didn't make it. So maybe also we can talk a little bit about that. But let me just start from the basics. Mm-hmm. The basic problem in the Euro crisis was that when some states were in trouble, then the balance sheets of the banks really got bad, and when the balance sheets of the banks got bad, the debt problems of the states got worsened. That has two halves, as I was saying, the fiscal and the banking side. From the fiscal side, there's something strikingly different in this crisis compared to the previous one. Not only the Eurogroup's actions really very quickly making pretty large decisions, but also the Franco-German proposal for a recovery plan in Europe, pretty well endowed with 500 billion of direct grants, which seems to be, it's very much in accordance with what the European Parliament has been pushing and seems to be taken up by the Commission and likely to pass. Why has it been so different this time? And what has particularly explained the shift in the stance of Germany, in your view?
I think, so one is the initiative came out of Berlin and Paris. So it was, and it's not so different from the Juncker plan, which was also imposed earlier on and implemented. But I think the big innovation is that the EU might get some taxing authority to tax corporations and citizens. I think that's a huge innovation. And there's also recognition that you need more tax harmonization, and it's probably easier done if you give some power to Brussels to, tax corporations and wherever there are a minimum tax in the EU. I think it's also the big difference to the Euro crisis. It's a shock from outside, and there's the moral hazard considerations are much, much less compared to the Euro crisis. So there is no excessive spending, or there's no mistakes made earlier where you could say, you ended up in the situation because you overloaded your debt. And this was just an exogenous shock coming from outside, nobody's fault. So the willingness of the German public is actually way, way higher to help out in these dimensions.
But you said, Markus, that part of the problem in your book, The Euro and the Battle of Ideas, you have said that part of the problem was that France was willing to transfer resources but not power to Europe, while Germany was reluctant to transfer more resources to Brussels. So now we see potentially Germany being willing to transfer more resources. Do you think we'll see some transfer of also power? Do you think France has also, not just Germany, but France has also moved in this equation?
It's more difficult for me to judge. I can see it. I mean, you have a president who thinks very European in France, so that might help in many dimensions. And that's, at least there's the hope. But you have to keep in mind that, there's also a huge challenge for the European Commission and other European institutions. There's huge responsibility to spend such huge amounts of money wisely. And if you don't spend it wisely, I think it will backfire big time. So there's a huge challenge ahead for all European institutions to make the best out of it. And it's likely might not go right in a sense.
It's interesting when you say that. It's interesting what you say there, Markus, because indeed you mentioned in your book as well that during the Euro crisis, there was a big mistrust about the ability of the European institutions to handle this. The IMF was seen as a safe pair of hands, but the Commission was not seen as able to handle this type of challenge. Now that has also changed. This is going to fall in the lap of the European institutions. Do you think there is a higher likelihood that the European institutions are ready? Is there a capability there? You seem to be concerned that there isn't.
No, I think there is a capability there. I think the new leadership is very, professional, and I think there probably is a much better capability to implement these things. I would like to mention another point, which I think you shouldn't underestimate, is the global perspective. Before, when Obama was president of the United States, there was, not so much a need of, there was a need of Europe, but now it's even more that Europe has to unite and to speak with a common voice and develop something. So this dimension is, you shouldn't underestimate it all. But essentially, to keep the Western values alive and all this, it's very, very crucial that Europe stands united and essentially commits all the resources and expertise to keep the European values alive. And that's, I think, a huge recognition all over Europe that this is very, very important. You have to stick together and make the most out of it.
So one issue with the fiscal expansion that we have seen is the huge debt overhang that most countries in Europe will come out of with. And this has been the situation for Italy in the past, not so much for the other countries. Now it's going to be something that will probably happen to many, many countries that have very high debt levels. You have the most beautiful phrase in an image that I've seen in your book. It says something like, emigration is like a private default on government debt, right? So there is a big debt overhang. I need to pay a lot of taxes. This is going to be all my life there. So I emigrate. That's kind of the way to default on this debt. Yeah. And that, I think we have seen, you and me having so many Italian colleagues, very talented everywhere. We have seen that kind of emigration as private default situation for all these couple of 3 decades. Do you think this debt overhang is really going to hamper the growth in Europe? Can we grow? Can we continue with these kind of debt levels? Are you very worried about this or not?
I think one should be worried. So the high debt levels are a problem. We see it in Japan and in other countries. They have huge debt levels, but they don't get out of a low growth environment. I think that's a huge challenge. On the other hand, high level of debt with a low interest rate, it's essentially the interest burden which kills you or makes it very, very difficult. Mm-hmm. So as long as the interest rates stay low and there's confidence in the various countries, I think we are safe. So it's only when there's, of course, always a good and a bad equilibrium, if I may use some economics language here. You might switch to the bad equilibrium. You have a high interest rate, hence the default rate is higher. That justifies the high interest rate. If you jump to this bad equilibrium, then actually the dangers are very high. So if you have a low debt levels, you never have this danger of jumping to in a bad circumstance or bad equilibrium. Now we have these dangers, and we have to watch out much more, and we need a much bigger or better institutional framework to make sure we don't jump into this high interest rate, hence high default rate, hence very bad equilibrium.
So in that sense, to avoid that bad equilibrium, people like John Cochrane have been arguing, I have been also arguing in Europe, but people like John Cochrane have been arguing that we should be going into really, really long dated debt, use this chance that the debt markets are giving us to borrow even perpetually with very low rates and get this insurance, lock in these low interest rates forever. Other people, like Alan Blaney, for example, have been saying, no, don't worry, just go for the lowest possible rates, roll over very short dated debt and use that to have the lowest possible debt cost. What's your view? I mean, how should countries be considering long dated securities to avoid this bad equilibrium?
Yes, so it makes sense to issue more long-term to the extent you can place it on the private market. To the extent it's just bought up by the ECB, then it's really going from one public hand to another public hand. So it doesn't really help. So it has to be really placed into the private market. And then it's also a question, how costly will this insurance be? So it's wise to buy some insurance, But if it's too expensive, at the moment it's not so expensive, so you might want to take advantage of it. You should buy this insurance because it's a stabilizing force, and knowing that it's a stabilizing force, you take uncertainty out of the system, and that allows private companies to some planning stability, they invest more, and that might actually bring growth rate up. If private companies worry that there might be a default in your sovereign bond or not, then it creates a lot of uncertainty whether you jump into band equilibrium or not, using the same language as before. That might actually be a bigger problem then.
So now to go to the other side of the doom loop, the financial, the banking side, you're one of the foremost financial economists in the world. And one of the things in working in this finance macro interface is thinking about, have we done, there's a banking union in Europe, there are some steps, have we done enough to prevent the recurrence of the doom loop? Are we going to see Paul de Grauwe in the show, was here 2-3 weeks ago, and he said, we won't have a debt crisis this year, but it will be possibly around the corner by February, March. By next year, it could be there. Have we done enough to avoid the whole doom loop recurring?
We did a lot. So this progress was tremendous. Not everything is completed. I think we have several open issues. I still think for the doom loop, there are certain dangers. So let me give you an example that there's always a tendency or the danger of a government to push losses onto the financial sector, because the financial sector now they have to be bailed out at the European scale. So for example, if you have a mortgage moratorium or something like that, you push problems which are in the household sector onto the banking sector, knowing that they go away from the national problem into a European problem, and then the or some European entity has to help out. So there are some incentives which make the whole resolution more difficult because you can push it across institutions, and that's still we have to deal with. And with regard to the doom loop, once you push it on the banking sector, the doom loop kicks in again, and then the whole thing we might face again. Of course, we have a much better banking resolution framework at the moment compared to 10 years ago. There's no comparison, but there's still a lot to be done. Okay, so I would say the glass is more half full than half empty, but of course it's not full. So we still have to do a lot.
So what are the main big steps forward? I mean, you talk about resolution, but it's also true that resolution hasn't been really used over the last few years. It was used in Spain for Popular, but then after that, each country has been doing their own dirty laundry on their own. I don't know if you would agree with me on the German Nord-LB case, but clearly the Italian Veneto banks. So resolution is something, although incomplete. Clearly supervision is clearly done. The SSM is there. Deposit insurance is not there. Is it how half full is it, the glass?
Yeah, I think I agree it's a big issue, but I would also put a little bit, we also need is more on the financial market side. So we need more venture capitalist structures. We need more asset. We can't just rely purely on the banks. So we have to, there will be a shift away from the banks more to capital markets. And for this, more harmonization on that sense, of capital markets union, there was some progress as well, but I think less progress was made on the capital markets union compared to the banking union.
Sure.
And on that dimension, to relax a little bit that all the burden is on the banks, I think that's very, very important. The second thing is, at the moment, the system is still relying a lot on the ECB intervening. So the fact that the fiscal authorities intervene a lot helps a lot, but the main player still is the ECB. And that's why we need much more safeguards in place in order to take the ECB a little bit out of they always have to be the first actor to defend.
So, I mean, this is a question that has worried, particularly the position and the role of the ECB has worried particularly people in Germany. There has been a current of German economists who've been always kind of out of the mainstream in being particularly worried about certain aspects of ECB operations. And I would surmise here, although you obviously know much more about this, that those economists' views have been very influential in the recent decision of the Constitutional Court in Karlsruhe that has put in question both the operations of ECB and the proportionality of what it's doing. I guess for our listeners, we would say the cost-benefit analysis of what they're doing, and also the decisions of the European Court of Justice concerning those programs, dealing a double blow to Europe from Karlsruhe, both to the independence of the European Central Bank and to the supremacy of the European legal order. That would be my view at the very least. What's your view, Markus, on how much this ruling is going to potentially affect the effectiveness and independence of monetary policy in the future? And how do you analyze this ruling?
The way I see it, I think in the long run, it will mostly be handled by the German government and the German parliament. So the ruling essentially says the German parliament and the German government has to respond to that, and probably will drag in the Bundesbank as well. And the ECB essentially stated already they are on top of it, and they are really, responsible to the European Court of Justice rather than a German court. In this sense, I don't think it will have a very long-lasting impact. What's very, very important is that the ECB maintains its independence, and that's a very German principle to put in place with the Maastricht Treaty, that the ECB is very independent. It's the most independent central bank in the world because it's based on an international treaty. It's not a law you can change at any moment. And that's, I think, that's very important. And this court ruling calls this a little bit in question, but I think the ECB essentially has to fight back on that. And I did already in a very clever way, in my view. So I don't think it will be very influential in the long run. It will be dealt with. And it was also one of the motivation of Angela Merkel to push the German-French plan forward for the big fiscal thing. So in this sense, it had a positive input that to say, okay, we have to get a little bit the ECB out line of fire. We have to do more on the fiscal side. And that triggered then this huge innovation on the fiscal side. And that's what we wanted all the time, in a sense that you have more on the fiscal side, more on the bank regulation side. Not everything is on the monetary policy side.
So in that sense, you do see a good upside of that ruling in that sense.
I see a good upside in this ruling. I think it's good to clarify this, and there will be perhaps some changes in the communication of the ECB to be a little bit more clearer. I think they are pretty clear and very transparent already, but on the margins you can improve something here and there. I think what's important is that Germany is very strong on independence of central bank, that this remains. And sometimes if you have an independent central bank, you might not always like what an independent central bank does. That's what independence means. But I think what's also very important that the ECB communicates in a way that you don't lose the German public. You don't estrange from the German public. I think that's a big challenge for the ECB, but it has nothing to do really with this particular court ruling. I think it's very important that you connect, that the Germans see the ECB is our central bank.
I think that Isabel Schnabel's appointment has clearly been a very good step in that direction. She's very much communicating, explaining all the time.
That's the key. I mean, that's one of the key roles she has to take on and is taking on, communicate and make the ECB for the Germans always their own central bank.
People like, when you talk about independence, people like Turner and others have been worrying about can central banks preserve their independence and their legitimacy once they are not just doing monetary policy, but they're basically determining the price of risk throughout the entire economy, lending governments, lending corporates, deciding this corporate survives because I'm going to lend it to it or allow it to be used as collateral, etc. This other corporate doesn't survive. How do you see this independence in a context where banks are doing much more than just thinking about inflation?
No, I think there's a good point to be made, and that's also very consistent with the German way of thinking. You have a very clear mandate, it's very clear, and you enjoy independence. Once you go beyond your mandate in other territories, then you might lose, or you have the danger of losing your independence because you go into territories which are more fiscal or which are more, with other goals, and that requires a clear, very clear justification that you go beyond that, and that's why I think it's very good that the fiscal side or the government step forward to do something on their own. and help the ECB to stay within the mandate more easily.
So you've written, Markus, about banks, about financial dominance, about the fact that banks do have these incentives to become too weak. Then they have the ear of the exchequer, of the finance minister, who, when things go bad, always has to call the bankers, and the bankers always have a very good line to make sure that whatever happens, they are not ending up too badly off. How is this financial dominance playing in this crisis, and what should we do to make sure that the interest of the citizens come first?
So let me just put in the context. There in the literature, there's this fiscal dominance versus monetary dominance, which is, who is in the driver's seat, the central bank, the ECB, or is it the national government? And there's always a game of chicken going on between the two. But what I argue, there's a third player, which are the financial sector, and they might also have a huge influence, and might be part of this game of chicken between the government and the central bank. And what one should do is that the financial sector has to some extent an incentive to pay out dividends early, because as I said earlier, the government has an incentive, if there's a lot of extra buffer in the financial sector, to push losses onto the financial sector, like having this mortgage moratoriums or other initiatives. You push it on the financial sector. So the financial sector, recognizing this, they say, okay, let's pay out the dividends and bring the dividends, into safety. And then we are weaker, then nobody can push losses onto us. And so the first measure you should do as a government is say, okay, no more dividends. Like in the US, it means you have much tighter stress tests, and because of the stress test, you're not allowed to pay out any dividends anymore. So this should be done already now. So dividend payments, and that also includes bonus payments, they should be limited already at this point to make sure that the buffer stays strong. And there will be hiccups down the road. And now we have to make sure that don't weaken, or that strategically don't weaken themselves, so that we don't have the buffers, and then the taxpayers to jump in to help them out.
So that's I mean, from the economics committee, we've been calling for that, and I think the ECB and the SSM have been, at least they've been recommending and requiring. I think the banks have been more careful this time than the previous time in decapitalizing themselves. So I would like to take now a broader and a little bit longer term picture. When we look at inflation over longer periods of time, what we see, and what you have pointed out and others, is that, I mean, the fiscal side of things matters a lot. I mean, there was hyperinflation in the 20s because there was an hugely excessive debt buildup over the First World War and the reparations and all that period. Now, nobody's worried about inflation. Everybody thinks, well, it's a deflationary shock. Nobody's going out to shop. Nobody goes to the restaurant. So nobody's consuming. So we're going to face deflation for the foreseeable future. But history tells us that there must be inflationary risks. And many people say, well, if inflation returns, not such a big deal, we'll raise interest rates a little bit. There are two things to me that limit our ability to raise, or central banks' abilities to raise interest rates just a little bit, which are the financial system is really hooked on these very low rates. So if you raise interest rates a little bit, the whole financial system is going to put a lot of pressure to revert. And states, governments are hooked on these very low rates. So it might not be so easy to soak excessive inflation very fast. What's your view on whether there is a risk or not? How sanguine are you about this being just, okay, it's a deflation shock, don't worry?
I think, so it's indeed the case that in the short term and in medium term, we have more disinflation risk, or very low inflation risk. But then later on, we might higher inflation risk, or I call it this inflation whipsaw, or it might change then. And then what's really important is you need, let me compare the ECB with a race car, okay? You need a car which has good accelerators, but also very good brakes.
Mm-hmm.
And so right now you have to put the accelerator on, but you can put the accelerator on because you have the brakes. When the next curve comes, you can slow down again. And one of these brakes is, of course, the independence of the central bank. So you have to protect the independence such that you can put on the brakes. At this point, it's very easy to put all the programs, but then it becomes very unpopular when you put the brakes on. And that's when you need essentially the independence. And that's, I think one should prepare already now for this potential possibility that down the road we have inflation pressures. And as you said, it will be very, we might not have to raise interest rates a lot, and it creates already a lot of problems. So the fine tuning will be very, very delicate at that stage. And we have to be essentially preparing for this and have a monetary framework which takes all of these things into account, in particular the financial stability and the sovereign debt issues if you hike interest rates. What really matters is indeed the real interest rate, not the nominal one. So if inflation goes up and the real interest rate stays low, the states and the governments will be able to handle that because tax revenue is growing at a faster rate if it comes. So that's what matters. But you have, for me, also some tailored principle. If in order to get inflation down, you have to bring actually the interest rate up more than inflation. That means the real interest rate would go up, and that would kill. That would actually, or not kill, but would slow down the economy significantly once you want to control this. And doing this more longer forecasts, we know from history, we know it depends very much what you do down the road. And what's very instructive is if you compare the UK and Germany after the First World War, both had high debt levels. Mm-hmm. And in the 1920s, there was a big decision in the UK to go back to the gold standard. So they brought inflation down even to the deflation, which Keynes criticized big time. It was not wise to go to the same gold standard level as before. But Germany, there was Rathenau who couldn't really implement in 1920s the fiscal plan down the road, or like UK did. So they gave up and went essentially for the inflationary route. So the possibility, the political stability is very crucial to have also ability to bring the fiscal situation in order again and not drive into inflationary territory at that point. But it's all, and it depends what you think what happens in 5 years. So it's a very long run thing. You have to have good institutions. That's the key. The good institutions which can do things and implement some even unpopular measures.
From the perspective of the independence, which you're saying that it's absolutely essential for this to work out, it would seem that it might be that Europe is in a better place than the US or the UK in the sense that it's very difficult for a particular government, a particular president, to put a huge amount of pressure on the European Central Bank because there's 27 people there from all over the place, etc. Whereas in the US, you could see at some point somebody like Trump, interest rates go up, just says, well, I'm going to fire this guy and I'm going to change the laws that I decide. Do you think that in some sense the European framework might be more robust if it came to this problem?
Definitely with respect to the independence. I mean, the ECB has a much more secure position, and that will allow the ECB to put the brakes on if it needs to be. So that's a positive factor. Of course, it's not guaranteed. You don't know what, but what I also said, in order to bring the inflation down, you have to implement fiscal measures as well. So that's when we come back to this game of chicken between fiscal dominance versus monetary dominance. If the fiscal authorities or the governments don't do anything and don't bring the high debt level down once the whole thing is booming again, then it might also go the wrong way. So the central bank alone can often not do it if the fiscal authorities or the governments don't react to it.
Let me go back to the third leg of your chair, which is this financial dominance aspect, which is the bankers will be whispering on the words on the ears of the central bank and the governments. Please don't do this. You're going to bring the whole financial system together, because the truth is the financial system is used to extremely low rates. And when the rate is zero, right, you can explain to our listeners, any little move is going to make a huge difference to the prices of long-dated securities. So how will this, in this particular moment, how will this financial dominance play out? In that moment when things need to change.
Yeah, so indeed the big problem is that everything is way more sensitive at the low interest rate. So you move things a little bit and asset prices jump around a lot. And on top of it, so one of my big research agenda is also bubbles. Once the interest rates are so low, you're prone towards bubbles which can burst as well. So that makes the whole situation, the financial stability, way more hard to handle. And then there will be a lot of lobbying pressure from the banks, not to increase the interest rates. But there's also a big pressure from the fiscal side. Let's suppose you were to hike the interest rate you also have to pay a much higher interest rate on your excess reserves as a central bank. Now we have huge balance sheets and we don't pay anything, or we charge a negative. The banks have to pay a fee. Once you hike the interest rates, suddenly you have to pay interest to the banks. And that is also costly for the central banks and ultimately to the taxpayer. And there might be a rethinking as well. So in the US, you only pay interest on excess reserves, but I can imagine at some point what you call excess reserves and what you call regular reserves will change, because in order not to have to pay interest rates. And one way out of the Second World War was essentially a financial repression regime. That you say, I limit what people can invest in, and I essentially tax all the financial aspects of the economy. And that's another way to get rid of these high debt levels down the road. That's how the UK did it, the US did it after the Second World War. Just have financial repressions on, pay very low interest rates, perhaps even in real terms negative interest rates to the savers in banks, and thus bring, by having higher inflation and bring with negative real interest rates, bring the debt burden down.
I mean, we will have to be creative about ways to bring the debt burden down, because what will come out of this crisis will be very large levels of debt, I'm afraid. So one last question, Markus, about, you've been notably skeptical in your research. You have actually worked pretty much on the idea that interest rates lowering, making the monetary policy so expansive that you lower interest rates very much at some point, not only doesn't help, but potentially hurts. You've called it the reversal rate. Can you explain us what it is, and can you explain our listeners what it is, and also tell us how can we tell if we are close or far from that particular moment when it's not really helping?
Yeah, so there's essentially a reversal interest rate, where I say if you cut the interest rate, normally when you cut interest rates, you stimulate the economy, so it's a positive stimulus. But if you cut it too low, at some level, an interest rate cut becomes counterproductive. It's actually contractionary. And that's when, of course, that's what the reversal rate is when you go below that particular threshold. And main reason for that is that once you cut the interest rates, the banks lose money, and you need the banks to channel through the funds in order to start new loans, new projects have to be funded all through the banks. And if the banks are not well capitalized, you decapitalize them, and then they don't do this credit intermediation, and that chops off the growth level. And then the question is, where is this threshold? Is it minus 1%, or is it minus 2%, or minus 10%? Who knows? So we calibrated this. It's very hard to estimate this at minus 1%. But there are two elements to it. One is that it's at minus 1% when you start, but then it gets up, it becomes minus 0.5%. So you cannot stay so low for too long. So we are already fairly negative for a long time. So that's one problem. And the question is, how will you find out where really this critical rate is? And the only way you can find out is to get there, because you have no data points. You have never been there so low. So it's very hard to have a model which projects to some point where you've never been. And so the policy recommendation is to just tiptoe, with experiments, go closer and closer and see, is credit volume still going up, or is it not going up? And once you say, okay, now the credit volume is actually not going up, I cut the interest rate, it's not going up, then you have reached this point. So you would never do a big interest rate cut, you always do very tiny. And if I may say one more thing, so the ECB made a very smart move by essentially saying to the banks, if you borrow from us to lend to the real economy, you can actually borrow from us at minus 1% and then park it to us at minus 75 or 0.75%. Okay, so this way, essentially you can borrow at the lower interest rate, but then you can park at the ECB, conditional that you pass it on to the real economy. This way they recapitalize the banks. So it's a very smart, only few people observe that, but it's a very smart way to get around it and push essentially the critical rate further down.
So I promised at the very start to come back to our SBIS. How much would having something like this PBS, how much would having that proposal passed by Council help at this point? How much, how important would it be for the future of the economy, in your view?
So the SPPS or SPs, they have two advantages. One is, as we mentioned and talked about earlier, is the diabolic loop between banks, or doom loop between banks and the sovereign debt. But the other big advantage is this flight to safety across borders, that you can rechannel them. So flight money or capital is flying out of Spain, Italy into Germany and depressing the German interest rate and bringing the Italian interest rate or Spanish interest up. And you can control this with the ECB. The ECB can just undo it. So money is flying back into Germany and the ECB is just buying the Italian bonds and just channeling it back. I don't like a system where some entity has to intervene all the time in order to stabilize the system. I like a system which is self-stabilizing. So you don't have to intervene. You just, the market is doing its own thing and it doesn't create a crisis, some additional risk out of nothing because it's systemically designed. And that's where the SPs or the SPPS would be very useful, because you would rechannel the funds automatically back to Italy or Spain without the ECB having to intervene with these huge sums and undermining essentially to some extent the ECB's independence and making it harder to fight other fronts on the monetary policy side. And that's, I think, in terms of having a more coherent architecture, it would have helped a lot. Would it have shown up in lower interest rates for Italy? No, because the ECB did all the job. The big advantage is that the ECB wouldn't have had to do all these interventions or to the same extent of the interventions.
Well, it was really, really a pleasure to talk to you, Markus. It's always learned a lot. And you're doing extremely useful and important work during all this crisis. So thanks for that as well. And look forward to being in touch.
Yes, let's stay in touch. And you're doing important work, even more important work for the real world. And
I hope we can do something in Europe.
All the time.
Thank you, Markus.
Bye, Luis.
It's a pleasure.
Good talking to you.